Welcome to the F-Sharp Podcast, presented by Harmoney Wealth, a podcast geared to educate you on all things financial. Co-hosts Tanner Bortnam and Adam Henning discuss various financial topics presented in a consumable and entertaining manner. Tanner is a certified financial planner, JD, and financial expert, while Adam is a marketing professional and small business owner. It's time to harmonize. Sit back and enjoy the episode. Your future self will thank you.
Welcome to the F-Sharp Podcast presented by Harmoney Wealth, a podcast geared to educate you on all things financial. I'm Adam Henning, marketing professional and small business owner. I'm joined as always with co-host Tanner Bortnam, JD, certified financial planner and financial expert. Tanner, welcome to episode 45. I feel like there are things throughout the week and in the weeks when we're not recording that I always see and want to, I'm going to bring that up to Tanner and ask him. And then I forget to write it down and I forget altogether. And I know I had at least two or three this last week I was going to ask you, but can't remember them. So we'll just jump right into what we're going to talk about. I should probably do a better job of doing that. And I don't know.
Yeah, write those down.
Yeah. So maybe you'll cover them indirectly with episode 45, market update, quarter two, coming to you in the middle of 2023 in July. The middle of July. Apologies for a little bit of time off for us. Enjoying the summer a little bit, and we missed an episode. So if you noticed,
well-needed vacation.
We appreciate you. If you didn't notice, well, just, continue on. So yeah. Do you want to share anything fun with your vacations?
No, it was just nice to have some time off, be able to relax before, for any clients, obviously, that listen to this, they know we're in the grind, because TD Ameritrade, for people who may not know this, TD Ameritrade got purchased by Charles Schwab, and, that merger is happening. And so all advisors who used to work with TD Ameritrade had to decide whether, where they're going to go, because their custodian went away. So we're in the grind of that, moving clients over. So, to our new custodian. But besides that, it was nice to have some time off ahead of that and be able to, kind of prepare for the months of July and August here. They're going to be super busy.
Right on. I'm all switched over and looking forward to everything in the new custodian. So pretty seamless.
Yeah, it'll be nice when it's done.
The days are getting shorter and the snow will soon fly. It'll be quick as we wrap up market or update to quarter two. You won't get snow, but
no.
All right, let's jump in. Federal interest hikes. Let's talk about those. Two more hikes. Talk about that for us.
Yeah, so you're just kind of laying this out so everyone knows we're talking quarter two. So, April, May, and June of 2023. There you go. Probably want to switch the screens, Adam.
Hey,
perfect.
It's been a while.
That's all right. Yep, we had some time off. So yeah, there's two more rate hikes. And then they paused in June. So they did nothing in June. We had a rate hike in April and May, and then like I said, a pause in June. So now we're up to, the 5 to 5.25 range in the federal funds rate. And it is, the pause in June is a good sign. I know we've been talking about that a lot in our quarterly updates, that it'd be, or any of our episodes about inflation and rate hikes, that it would be nice for, my thoughts are, it'd be nice for the Fed to take a pause and let some of the data catch up, since most of the data takes 6 to 9 months to work itself into the economy. So here we sit in July, we're starting to see the ramifications of what happened in October through January of last year. And there's a lot of rate hikes yet to come down the pipeline that have already happened but haven't fully worked themselves into the market. So it's nice that they took a little pause, let a little bit more of the data come in, and lo and behold, some data came in just last week that inflation continues to come down. It's currently at 3.8%. Again, this is the beginning of July, but it's good. That's good data. We're trending in the right direction. It's not at the 2.0 mark that the Fed targets, but it at least is, moving in the right direction. It continues to be sticky. It's not transitory like they said at the beginning. It's sticky, and energy prices coming down, oil prices coming down in the second quarter of the year here have really helped that. So if you take those out and you take out food, which is pretty volatile, I think we're closer to 4.5%, something like that, roughly. Again, still plenty high, and a lot higher than the Fed's 2.0 mark, but making progress from the 7, 8, 9 that we were, a mere 6 to 9 months ago.
What was it last quarter? Do you know off the top of your head?
No. I don't know the exact numbers. I believe in March we were probably sitting around the 5.5, maybe 5.5 mark, somewhere around there for inflation. I don't recall exactly what it is. But again, we're making progress, and that's a good thing. But there's still more work to do. And as we've talked about on previous episodes, it's, does that mean the work has already been done because we still have rate hikes that have happened that haven't fully worked themselves into the economy? Have they done enough? Do they need to do more rate hikes? Or, as we always talk about, the money supply, M2, the monetary policy that they can tighten as well. And they have been tightening that. And we're not, I feel like a broken record saying this, that we don't ever really get a lot of news or questions for, Jerome Powell when he goes before, anybody really on the money supply. And they have been tightening it slowly. That also helps put the clamps on the economy. So we're still kind of in this waiting game. We're closer, we're closer to the end of the game, where we're going to know whether it turned out okay and they had this safe landing, or whether they, overcooked it and overshot the runway. We're like I said, we're closer to that than obviously we were 6 months ago, but we're still, we still don't know. And consensus from the Fed is they believe they're going to have to raise rates 2 more times by the end of the year, and then hold the rates higher for longer. Again, who knows whether they do that? Who knows whether they do 1, maybe they do 3? We don't know. That's obviously up to them, but that's what they are telling us, is that they expect to raise rates 2 more times by the end of the year.
And then hopefully inflation follows suit and we get that down and reined in. And then at that point, are we at a point where we can kind of close the pandemic book and move on? Or is that kind of overgeneralizing?
I think that's a really great question, actually. I would hope so. But the problem is inflation is driven off of spending. It's driven off of money that goes into the economy, and Congress continues to spend at a rapid fire rate. Now they talk about how they've lowered the deficit, from last year by 10% or something like that. It's like, well, whoop-de-doo. I mean, if if you set the record last year for spending the most ever, and then you reduce it by 10%, you're still spending a ton of money. You're still, the deficit is still gigantic. So, it really just depends. To be very honest, what scares me is 2 years from now, well, not quite, year and a half from now, we have an election. And what we saw a year ago about this time going into the fall, and again, not trying to get into any actual politics of right side versus left side, just who was happened to be in charge at the time was the Democrats, and they passed a bunch of spending bills right before the election. Now, was that to get the bills passed before potentially losing power? I'm sure there was some of that. Was that to potentially try to buy votes because they were getting a bunch of money out to people and a lot of spending in that regard? Potentially. Does that happen again, a year from now, heading into the next election? It'll be a little bit harder because we have a split Congress, but that's the part where Congress likes to, wash their hands of this and blame it on, all this corruption in the business world. And there's profit gouging, there's all sorts of things like that are going on. But, to sit there and just point the finger and say that none of this is their fault is, I think, pretty foolish. Their spending is a significant portion of inflation. So if we can get that reined in, I think we can close the book on, as you said, the pandemic. But if not, I mean, the Fed may have to hold rates pretty high for a while just because there more money keeps getting put into the economy, by the government and spending, and thus they have to slow down the spending by keeping interest rates higher. So hopefully, I guess, long-winded answer to hopefully we'll be able to close the book soon.
That's good. Let's talk about market performance and how the markets have had a great start to the year 2023.
Yeah, they really have. I mean, being very honest, this is, you can go back and listen to some of our episodes at the beginning of the year. I did not expect this at all. I'll gladly admit when I'm wrong in this regard, when it's, I didn't expect them to go up and they did. Happy accident. It's been
Bob Ross.
Yeah, well, exactly. Well, I'd rather have a happy accident of thinking markets may not do so well and they go up rather than the other way and losing clients money. But it's been great. It really has. It's been a good, really good start to the year. I sure there are people out there who are going to say, yeah, I predicted this, but those are people that probably think it's always going to go up, as we've talked about. There's people that think it's always going to go up or always going to go down. Some of the things, though, I'm still cautiously optimistic. I mean, the results are in for the first half, and like we've said, it's been great. However, where I get some caution is that it's been a very narrow market. Now, some of this data is from the middle of June, so they haven't re-updated it yet as of when we're recording this. So it's about a month old, but it still is fairly accurate. And it's a very, what they call a very narrow market. So in the S&P 500, obviously there's 500 stocks that comprise that, and it is a market weighted index. And so the bigger the company, the bigger the position that they have in the S&P 500. So Apple, for example, gigantic company, just went over $3 trillion of value as a company. They're going to have a big position. And of the S&P 500, so of those 500 stocks, 7 of them account for 30% of the market weight. So 7 out of 500 are 30% of the weight of the S&P 500. And those 7 also account for almost all of the gains of the S&P 500 up to this point. If you look at the other 493, they're pretty flat. The rest of the market hasn't been nearly as good as those big 7. The big 7, NVIDIA, Apple, Microsoft, Amazon, Google, Meta, and Tesla have had amazing years. All of them. Some of them have had really, really amazing years, like NVIDIA. But they have so much power and so much weighting that they can pull the S&P around, really. I mean, those 7 and they're pulling the S&P up while the rest of the companies are, they're doing okay, but they're pretty flat, on the year, the rest of the S&P. And that's the part where I get a little cautious, because when you have a very narrow market like that, if those 7 companies start to slow down, well, now the cracks in the armor start to show, because the other 493 companies need to start pulling their weight. Well, if they're not doing as well, now you may have the S&P 500 slow down. And as those companies I listed out, they're all in tech. So the NASDAQ has had an amazing year too. It's up, I think, over 30% so far this year. That's huge, 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 huge. But it's all tech. It's big tech and AI. There's been this huge AI craze. I'm sure everyone's heard about it. Chat GPT. We've done episodes on it, way back at the beginning of the year. And there's this huge movement, fear of missing out, and getting into a lot of these companies that deal with AI, kind of like the Bitcoin craze from 4 years ago and the GameStop craze. I mean, there's always these things, and I'm not saying AI is going to fizzle out like some of those other ones have. I think it's here, but it may be a little premature that people are running some of these companies up this high. So I think that's something to keep in mind and to watch for, is hopefully seeing the market start to broaden and some of these other industries start to pick up, and the other 493 companies in the S&P 500 start to gain a little traction. And if we start to see that market broaden, it's not just big tech AI companies pulling it, then that gives a lot more confidence. But I don't think we are out of the woods yet, so to speak. We very well, may go into a recession. A lot of people are still predicting that. They've just moved their timeline back from, the end of this year to start of next year. So it's still very well in play that could happen. So I just want to make sure, for any of our listeners, don't get a false sense of security just because we've had this huge run up in a certain area of the market to start this year. We're not out of the woods yet.
But does that surprise you, knowing that so much of our daily lives is comprised of big tech and softwares, and it bleeds into other industries? Is it kind of recomputing itself, just because technology is always just going to be that big giant? So is it all that surprising that much weight is coming from those big companies?
No. Those 7, sometimes they only look at 5 of them or 10 of them, but those 7 have probably comprised anywhere between 20 and 30% at a given time of the S&P 500 over the last decade.
Yeah.
So that part isn't the weighting that they have in there isn't the part that's abnormal. What's abnormal is the fact that Nvidia's up 150+% and Apple's up, Apple, Amazon, Google are all up over 30%. Tesla's up huge. I don't know exactly what all of these are, but they're all up huge. That's the part that those 7 compared to the rest of the market, it's that's what is the abnormal part. You have, you can call them the Magnificent Seven. Again, that's an old term from a previous, decades ago of 7 other stocks before. But those 7 stocks are really pulling. That's what I'm trying to say, is it's not the way I use the weighting to explain how they have so much power over the S&P 500, but it's to make sure we don't fall into a false sense of what's happening. Because same thing, let's flip it, right? If those 7 start doing poorly, but the other 493 start doing well, okay, well, there's still 70% of the of the S&P that can do okay. The risk is with the other 493 not doing that great right now, all being combined pretty flat, maybe even slightly down for the year, but everyone looking at the S&P 500 and saying, okay, this thing's up 11, 12, 13% so far, we're out of the woods. And it's like, well, we're not, because it's 500 companies, but 7 of them are what is, basically what you're looking at that's causing that to be up that high.
Sure. Okay. Makes sense. And then we kind of teased a little bit earlier with some of the political forecasting in the next couple of years, but we had some news out of the White House, Supreme Court overruling Biden admin student loan forgiveness. Let's talk about that.
Yeah, yeah. So for any of our listeners, if you have student loans, obviously I'm sure you're aware of this, but just in case, um, the Supreme Court overruled the Biden administration and their plan, what to give the 10,000 and up to maybe 20,000 per borrower across the nation for student loans forgiveness. They said he does not have the authority to do so. I don't think that should shock a lot of people, to be very honest. Looking actually at the statutes, it was pretty evident he does not have that authority. When you talk with lawyers and people that are in that area that do that a lot, it was this, I feel like even in the Biden camp, I feel like they're going to say that this is upsetting and this is politically motivated and yada yada. But I think that they had to have known this was coming because they already have a second plan out within a matter of a week. So, they're trying a different route now. So, anyways, where we stand right now is interest will start accruing again. It's frozen still, but interest on any of those loans is going to start accruing again on September 1st.
And
And
how
then
long has that been
payments,
frozen since COVID?
yeah, since I don't 2020 for sure. So I don't know, March or June or ish range of 2020. So for 3 years, no interest has been owed on that. Which in and of itself is a huge blessing, right? You had an interest-free loan for 3 years, and
Hopefully you're making payments.
yeah, yep, yep. But again, so that interest starts September 1, and payments will start in October. And again, there are some things that they've put out, in case you're having trouble making payments starting in October. They're given kind of a little bit of another grace period and whatnot. So look into that if that happens to be you. But just wanted to make sure that we did talk about that because that's a big one here for financial planning and for some of our younger listeners that may have the student loans.
I do not miss those.
Me neither. Me neither. It's only way you get well, at least when I had them, the only way you got rid of them was dying. Now I think they are trying to make it where you could file bankruptcy and get rid of them, but still,
What?
I don't know if, yeah, I don't know if that, I don't know if that is going through. I was just reading an article that I believe they're trying to make that a potential avenue, which I think is a bad move to allow a young person to file bankruptcy, discharge student loans, not pay them back when you may or may not have any credit. So you're not really ruining a ton at that point in terms of your credit. But there obviously are some negative things. You have to report that for 10 years, and it's not like that should be taken lightly by any means. But the risk factor of a young person at age 22 filing bankruptcy is significantly less to them in their lifetime than a 45-year-old person doing it. So, yeah, we'll see if that happens or not. But yeah,
That
that's the
might be
update on student
a
loans.
standalone.
Well, yeah, I mean, if it gets allowed
just
or whatever,
filing
added
it
as
in
an
general, maybe, but on air
I don't
production
know.
meeting.
Yeah, we chat about it, but probably not. Because to be honest, I don't want to ever have any client that files bankruptcy. So I really don't want to even waste my time figuring out how it works, because that's not the goal. Goal is to have a good plan and never have to worry about that.
Very good. Anything else you want to add on this episode before we close up?
No, that's it. Not a ton in this quarter. Just keep plugging along with your financial plan. We're not quite out of the woods. Just don't yeah, I guess that's kind of it. Just don't jump in with both feet just yet.
Very good, sir. We hope this episode has been helpful. As always, thanks for listening. If you haven't yet, please like, subscribe, leave us a review. Give us a question or comments. You can email us at podcast@financiallysharp.com. That's podcast@financiallysharp.com. We're also on YouTube. So if you are watching us on YouTube, go ahead and click that bell and subscribe, and we'll see you and you'll hear us in the next episode.
This podcast is for informational and entertainment purposes only and should not be relied upon as a basis for investment decisions. This podcast does not engage in rendering legal, tax, financial, or other professional services. Investment advisory services are offered through Harmoney Wealth, a registered investment advisor authorized to do business in states where registered or otherwise exempt from registration. If you have questions pertaining to your specific situation, please contact Harmoney Wealth at 602-935-5155 or at harmoneywealthaz.com.